Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is January 18, 2023. I will cover the stock market, bond market, where things are going or have been going, and I'll give you my views on what I think this spells for the future. Let's begin with a dashboard. This shows the six major indexes, equity indexes, and the long-term treasury bonds. So we get four indexes for the U.S., the S&P, the Dow, the Russell 2000, and the NASDAQ 100. So interesting a cross set of views on U.S. equities. And foreign markets, EFA and EEM for the developed countries and emerging countries. So again, gives us a broader view of the world, including the U.S., and then the long-term government bond. So you can see that for the past, really for the past week and for the past 2 weeks, this is very favorable. For the past quarter, everything looks very favorable. So the long-term government bond is not up yet to the 200-day moving average, nor is the NASDAQ 100, but they have been moving up. And so generally a positive report for a short period of time. But last year we had so many times where it was red, a lot of reds. They were below the moving averages, and these four last columns show that they are above the 20, 50, 100, and 200-day moving averages, or below. Then when we break the S&P 500 apart, we see the 11 sectors within it and how they have been doing relative to those same 20, 50, 100, and 200-day moving averages. Most have been doing very well. What's interesting is the ones that did the best last year were consumers, most of the time, consumer staples and healthcare. They were down, but they were not down as much as the others. They are now doing the worst. They are not moving up much. And the ones like, telecommunication, retail, consumer discretionary, those are doing very well. What's interesting is that the NASDAQ, the technology sector, XLK, is not moving up as much as some of the other sectors. Industrials and value stocks are still continuing to do the best. This shows the S&P 500 over a 12-month period. It still is in a downtrend, trending market, up and down a lot, but you can see at the very end, it has crossed above its 20-period moving average and is slightly moving in a positive direction, which reflects the data that I just showed you. The value stocks relative to the growth stocks within the S&P, there are growth stocks like Apple, Google, Amazon, etc., and value stocks like Ford Motor Company and Boeing and companies like that. Two very different kinds of companies, but growth stocks are still out of favor. So normally you would think if we had hit a bottom from stock market top down to a bottom, usually what happens at a bottom is that what was out of favor comes back into favor. Growth was out of favor, and it is usually, because it's the most oversold, is usually the one that bounces back the quickest. Not so here. I don't believe we're at a bottom. There's lots of reasons why I don't think we are. We still have an inverted yield curve. We have not yet gone into a recession. We still have more rate hikes ahead of us. So I think we're in a bear market territory, and I think we have a recession in front of us. Is it going to be mild? Is it going to be moderate? They debate that, so I don't know. But I would say because of that, we're not seeing a bounce in the technology sector, the growth stocks, and that is reflected in this chart showing that it is still favoring value stocks. If it goes down, it favors value. If it goes up, it favors growth. So it's a ratio chart. The small cap is slightly doing better and definitely has done better this past couple of weeks, more so than the S&P 500. So, and I put the black line to show a slight general trend in an upward direction. The long-term government bond has been showing some strength lately. It had a very weak year and is what really pulled down a lot of portfolios. It's starting to show some strength, and you can see that at the end, but it is still, generally speaking, in a long-term downtrend. And the previous period of time, this is a 36-month chart, so going back a couple of years, you can see that that was the beginning of a long-term decline. If there are future rate increases, this means that rates are going up and bond yields tend to track with interest rates. So this would tell you that that will probably push down the price of bonds again. But you could argue, and I agree, some of that is probably already baked into the price. So, but I think if it, particularly if the Fed stays aggressive, and if rate increases are more than people expect they're going to be to fight inflation, that's not probably baked in, and that would push bond prices back down again. But the dollar continues to show weakness. Now, up until October, it was just going up and up and up. And of course, we're in bear market territory with equities and a slowing economy. And and here we are, the dollar is going up. Didn't make sense. Well, since October, it's turned around and the dollar's coming back down. And what that means is that it is more favorable for those in other countries that are not under the U.S. dollar. For their currencies, it becomes more favorable for them to buy U.S. goods and services. And vice versa, it therefore becomes more expensive for us to buy foreign goods and services if the dollar is in a declining period. Gold continues to surge up, and it is moving up quickly. I think it is now, I read something where it is now approaching a 9-month high. And then you can see that on the chart. Definitely favorable for precious metals. And then silver, same thing, continuing to go up since October. And but probably gold has actually gone up a little bit more than silver this time. When I put those on a ratio chart, you can see this is silver numerator, gold denominator. You can see that when it comes back down, that means that gold is pushing up faster than silver and vice versa. So this shows that while silver has gone up, this recent pullback in the last month, it just represents the fact that silver has gone up, but less so than gold. Bitcoin. Well, Bitcoin finally started to get some positive direction to it. So it's been in a long-term decline, down 75% for over a year. And then this last week or so has started to move up very quickly. And so we'll see where that goes. That's I don't buy Bitcoin to hold it, but there are traders here that are taking advantage of this, and maybe even some who want to just buy and hold Bitcoin. And if they do, they're seeing this as strength in the value of Bitcoin. The volatility index, I put a black mark on the right side of the chart to show the arbitrary level of 24, being that if it is below that, that is favorable for growth equities. And if it is above that, that means volatility, meaning downward pressure on equities, is in the market. So this is the volatility index of the S&P 500. So the downward direction at the far right of the chart shows that it is favorable to equities. And of course, we saw that in the dashboard. The Asbury Research, there are 6 metrics that they use. are, you can see that they are mostly positive. They got 5 out of 6 that are positive now, and only one that is negative. So again, echoing the same short-term theme for the past week or two. And the cross-asset relative performance chart comparing the ETFs in different segments to each other. And so you can see that high beta stocks are more favorable than low beta. Small cap is more favorable than large cap. We saw that in the previous chart, where you could see the tick up at the end favoring small cap. And developed countries are stronger than the U.S. Emerging countries still somewhat more favorable, but especially developed countries. In the bond or fixed income area, corporate bonds are showing more strength than government bonds, even though government bonds have been going up recently. Corporate bonds are going up more so. And long-term bonds are more favorable to short-term bonds. And in a growth market for bonds, that's favorable, that's going to be the case. And vice versa. And in a period that's unfavorable to bonds, like we saw this past year, the short term is probably going to show more strength than, or be down less than the long-term bonds. The U.S. versus the world. It's so interesting here that not one case of all of these countries and regions of the world compared to, these are using ETFs, using the SPY for the U.S. and these other countries, the ETFs for them. It's interesting that in many cases, in all of the cases, that the other countries or regions are doing better than the U.S. Not in a single case is the U.S. stronger than the others. Now, the U.S. may be mentioned, but it's not strong enough to get a green box on it. So you can see both developed countries and emerging countries all outperforming the U.S. When I put EFA, the ETF for the developed countries, on a relative strength chart relative to the S&P 500, this is what it looks like. The S&P 500 in this ratio chart is the numerator. The EFA is the denominator. So if it's going up, this favors the U.S. If it is going down, it favors developed countries, mostly Europe and Japan, but you could probably put Canada, Australia, and South Korea in there as well. So you can see how far the U.S. is out of favor relative to the developed countries. Interesting. And I can't tell you why. I think maybe part of it is the dollar, but the economies of those countries, at least in the past several months, has been surging more so than the U.S. Okay, I want to report on gold and silver. This is as of Friday. As I showed you, you could see that gold is going up, and it's going up more than silver. So gold was up as of Friday for the previous week, 2.9%, up to 1922 per ounce. It was in the 1700s not long ago, and we could tell that from the previous chart. And silver is up to $24 per ounce. This is a spot price. On top of this, and that's a 1.8% increase. So on top of this, you have to add the premium that you pay when you buy it retail. And the gold is about $100 or so per ounce, and this fluctuates based on supply and demand. And and silver, you add about $5 per ounce for that. So that's where it is, and definitely showing strength in precious metals. And what's interesting, I don't know if it's coincidental, but is Bitcoin is also showing strength at the same time. We are coming up on earnings. So this week and next week, earnings are being reported for the fourth quarter, and those are expected to be negative. and they are expected to probably push equity prices down. That's a consensus view. And so, yeah, not very good for earnings, the prospect. But I looked at the earnings that were reported on Friday, and I saw that there were a number of companies that had meet expectations or exceeded expectations. But there were certainly those that had fallen short of expectations. So in reporting earnings, particularly as it relates to the price of equities, it has a lot to do with what the analysts expect that to be versus what is actually reported. So it could be negative, but if it's less negative than they thought, that can actually cause prices to go up and vice versa. Thank you for watching. If you have comments or questions, leave them in the comment section and I will try to answer any questions you have. Thank you for watching.